Per usual, living on this channel is for educational purposes only and is not intended as financial advice. It's Macro Monday. Let's take a look at the flows report and some quick crypto TA in the front end here. Globally, flows are back positive after being negative the previous 4 weeks. We continue to see tepid, mild, lukewarm, flows. Not much is going to happen until price goes up or down. Okay. The ETFs will have an amplification effect, but like I said yesterday, thus far the people who wanted to buy have bought, and now there needs to be some catalyst for inflows or outflows, whether that be price or accessibility. So not much is probably going to happen until we're out of this range. We continue to see outflows from Ethereum, inflows in Solana, outflows from short Bitcoin, and the Hong Kong inflows are also minimal. So maybe worth watching on a week-to-week basis, but I don't think they're worth monitoring every day. We are still negative on the cumulative 30-day flows. So we do still have this start-stop phenomenon where we don't have this continuous churn of inflows like we did in 2020. We had a gigantic shot after the ETFs launched and not much follow-through past that yet so far, right? Besides the power law corridor, one other thing we can look at is the rainbow price chart. Silly and meme it may be, it has done a pretty good job historically, just roughly assigning a buy zone and sell zone, or several buy zones, several sell zones. We can look at where we are now relative to the last halving, and we're about where we'd expect to be. Again, I don't expect miracles to happen anytime super soon. The slower this goes, the better. What we don't want to see is anything like 2021. What we don't want to see is anything like 2019. We definitely prefer to see this slow grind that took months and months and months. That's preferable, lengthens the cycle in duration, extends price from lows to highs. One other thing to think about when we're talking about price and institutions is positioning. This is Jason Shapiro from Crowded Market Report. He does a free Substack. Every once in a while he talks about Bitcoin or Ethereum, but the key thing to remember here is we want to be on the opposite side of the blue bars here, which are large speculators. Commercials, the miners, are generally correct. Large speculators generally wrong. So the way this works is you're looking for max positioning one way or the other. It's good that this has flipped from basically bearish to bullish, but as he alludes down here, he just says not exactly a trade based on his system, but it's interesting to keep watching. He's also got ETH in here, and this is not a trade either. There's no trade as far as positioning is concerned. You can see how things looked October, November, how they look now, right? That's what we want to see. We don't see any of that. Just another interesting data point to show large speculators starting to hold shorts again, whether that's a basis trade or directional. I don't care. It doesn't matter. The COT data doesn't care either. Just another loose supporting data point for the long end here. We're back up above 63K at time of recording. We should get a continued squeeze here on the daily B bands. And again, this is the most important chart for the week. The most important data point for the week is going to be CPI. We could easily this week attempt to break down below 60 and then go to 67, right? Like we're setting ourselves up for a volatility event based on news. So I expect it to be pretty wild one way or the other. I don't expect no reaction. So for me, I'm kind of just waiting to see what happens, although it's encouraging to see some up creep here above 63. On the other 2x ETF MSTR, we also look intact on the inverted head and shoulders. Like I said yesterday, where does this go, right? I think this could go for an all-time high retest on BTC, on MSTR. Beyond that, we'll see. Beyond that, we probably need a little bit more than one CPI print, but it may set the wheels in motion for something to get going here on the trend. Looking at BitX on the 4-hour, not quite above the cloud yet there either. So look, we got time. This is going to line up exactly to CPI. That's just how it is. Everybody's kind of waiting. We did have some interesting GME, I don't even know what to call it, GME memery last night, today. AMC up 100%, GME was up, I think at one point 100% on the day. It was up 20% plus overnight. I don't know. It's all very silly. But some meme coins also popped up. This is Pepe. Was up over 20% today at some point. Nice TA consolidation preceding that. Doge, however, did not really do much of anything. It's up maybe 4%, something like that. Keep hearing people say they think it's a stock pickers market. I also feel like it's a coin pickers market, right? You got to sort of know a little bit about a little bit to see like, okay, Doge to me has looked weak for a while now, whereas something like Pepe, which fundamentally has no reason to exist, neither does Doge, but the technicals favored Pepe over Doge, have for quite some time. And I think we're not seeing this broad lift off of everything again because of the liquidity picture. US liquidity is still declining, flat, and there's quite a large gap between this chart crime showing total 2 relative to US liquidity. So there's just, we're going to have winners and losers on any given day. We're going to have some great TA setups, but I don't think it's broadly a time to spray and pray and expect miracles here. Before we go any further, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. Non-investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PVI, DBA, Kraken. Talked about this group yesterday as well. And just because I get people chirping at me on YouTube, on Twitter, in the Discord, look, alts broadly just aren't the move. You will have moves like Pepe that moves up 20% in a day. But bleeding or ranging is very much the norm here until liquidity comes back, rates come down, something. Alts need a catalyst and they do not have one. ETH, Sol, Doge, ADA, just not seeing much strength against BTC lately, and ETH just really falling off a cliff. ETH is getting to a point eventually here where it is starting to look bad enough to buy. Almost. It is almost getting there. Let's just take this example. We measure the fibs from high to low, pull that down. Like this measures extremely low relative to where we are. Even just this consolidation, let's say we're more conservative with it. We're just measuring candle bodies. Even still, that's 0.43. So we're almost there to take a stab. But I know the people that are hearing this are probably people who've been holding since the merge, and it's been down only, right? So look, I think there's more pain ahead for ETH BTC. We're still in the hopium copium side of things. I haven't quite seen much despair on the timeline for ETH BTC just yet. Looking at the calendar for the week, again, the only thing that matters is CPI. Everything else is just sort of icing on CPI. Bunch of Fed speakers, Powell speaking tomorrow. I'm sure he's going to get asked all about GME and the animal spirits and are we actually restrictive in rate policy and blah, 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 whatever, who cares? The CPI is everything, okay? So you will see a volatility spike when that number comes out. So expect that. As far as predictions for CPI, it's looking like we might be slightly unchanged month over month, maybe down month over month slightly, just barely. The problem is if you're trading on that expectation and you are wrong, you will be very wrong when the CPI number comes out. So if we look March to April, we had a jump in trueflation, at least from April to May. We did trend down, but it's hard to say whether or not that's definitive enough, at least in CPI. Looking at another way to measure CPI, I've talked about shadow stats before. Larry Summers was tweeting this out, this paper that he put together using the pre-1983 CPI calculations. And using this method, CPI got to like 18%. It's still quite high. This isn't to date present, but gives you some idea of how disconnected CPI might be from real CPI potentially, and or why consumer sentiment is the way it is. The market trades off the data. The only thing that matters is the data. Reality matters less to the market than the data. So the revisions don't matter. It's what happens on 8:30 on Wednesday. That's the only thing that matters in the moment, right? I would argue we want the data to reflect reality. So it's a problem that it's not reflecting reality. And maybe we should think about adjusting the CPI to reflect reality. In any event, looking at alternative data points to CPI, you get some idea of what's going on. This is the month over month predictions for the year over year percentage changes of CPI from the Fed. Again, it's going to be down to the wire as far as what we actually see. On Wednesday, it does look like core is headed in the right direction at the very least. As far as the probabilities from the Fed, likely to be no cut next meeting. These probabilities will probably jostle around after that data print, which is going to affect the US dollar and the DXY, and that's going to affect risk, right? It's all related. So if you're bullish, you want to see a weak CPI print, a weak dollar, and that will likely fuel, at least on the day, a risk on sentiment and risk on rally. Looking at liquidity and yields, the reverse repo, we're not really getting anything out of the reverse repo anymore as far as pumping liquidity into the markets. And that's, again, kind of why we've flattened out, I think, arguably across the board here, aside from some individual names. Yields have kind of been all over the place in the belly of the curve and the long end of the curve. The short end of the curve is still definitely where I prefer. And if you're bullish risk, again, you don't want to see a bear steepener. You don't want to see the long end come up to meet the short end. You want to see the short end come down. And we have not seen that yet. So expect yields to also move around quite a bit, depending on that CPI number on Wednesday. Yield curve still inverted. It's getting more inverted. Unemployment still below 4%. And GDP predictions above 4%. It's at 4.2%. So not a lot of reason to think a recession is imminently around the corner. You can argue all you want about what the data is, what it represents, how it's not collecting reality. I'm not going to disagree, but these are the numbers that are presented in front of us. These are the numbers that the market trades off of and the Fed makes decisions off of. So it is what it is. But so far, so good. No recession. Expectations imminently at the very least. I probably saw 16 versions of this chart last week. We used to see one of these a week in 2022 and 2023. This is pandemic era excess savings. And again, you've got the doomers sort of saying, look, it's all over for the consumer. They can't afford anything. Look at Starbucks, look at Walmart, look at whoever else, McDonald's. Not going to disagree. Not going to disagree. But what does this mean for the market? How do you trade on this? Does this mean rate cuts sooner? Does this mean more unemployment? Does this mean housing starts to collapse? No clue. I don't think you can trade this, but definitely an interesting data point, a different way to look at the US savings rate as a percentage basis over time, well before COVID. We're definitely back within the pre-COVID range. So to see something like GME explode with liquidity where it's at, with savings where it's at, it's definitely interesting. And even at the time, I think it's sort of a myth that retail alone was enough to push GME higher. There was definitely follow through from Wall Street to push GME higher. So even now, yes, I'm sure Main Street is piling on to things like GME today, but I'm also sure that there are probably many hedge fund names that are doing the same. So it's not always, let's just blame retail for what's going on here. As far as the dollar still looks great. Dollar still looks strong, which is a problem for risk. We're down from highs of the past couple weeks. None of this looks bearish. You want to see bearish, right? Go to the ETH BTC chart. This is nothing but lower highs, nothing but lower lows. Drip, 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 right? We're not seeing that from the dollar. We're seeing sustained strength at the highs in the range. Can this fail? Yes. Is this manipulated based on XYZ reason? Yes. So any further successive low will be super bullish for BTC. If we're below 101 anytime this year, I certainly would expect BTC to fly higher. I certainly would expect ETF inflows to go off the charts again. Below 100, and we're talking 100K BTC. Easy. If we aren't at 100K BTC, if and when the DXY falls below 100, I would be shocked. We're just not there yet. DXY still looks quite strong. And this is another part of the problem. UJ, which is feeding into DXY, continues to regain strength after several interventions by the Bank of Japan. They've tried to squash this thing a couple times over the past couple weeks, and it just keeps grinding higher because of the rate differential and the carry trade. It just makes more sense that this continues to grind higher. That's just inevitable. So what is the Bank of Japan going to do? I guess we'll find out. If there's going to be some sort of Fed swap line to make sure this doesn't go to infinity so that UJ doesn't cause some sort of yield sell-off, whatever, right? Like that's a possible outcome here. And UJ continues to look very strong. As far as legacy is concerned, I think again we're just waiting for the CPI number. This looks more bullish than bearish. It survived the dip in the cloud with a bearish TK cross. It's likely to get a bullish TK cross today. It looks fine. I don't think there's a lot of people excited about buying up here just yet. They're going to need a reason to do so. They're going to need a catalyst. So I'm certainly less bearish than I was in March. I think March 11th was the day I put out a video saying I'm finally a legacy bear. But I don't see a lot of great reasons to be buying the index up here. The same thing with the Qs. They look fine. They look okay. I think there's better individual names than the index. Certainly less bearish than it was a couple weeks ago. As far as the Mag 7, Apple came out and said they're buying 110 billion of their stock last week. So of course, the stock went up. And as far as the range is concerned, this to me is not a trade based on technicals. It wasn't a trade down here, not really a trade up here. I just think there's better stuff to do with your money. That's kind of it. Microsoft looks okay. It is at the risk of a head and shoulders up here. It's pretty close to the old cup and handle target. This may need some time to regather strength. But again, it's not like screaming, buy me. You know, there's no like imminent breakout. There's no October, November style chart pattern. There's really nothing here in the moment on technicals that's exciting. NVIDIA looks okay. Again, it's like all this stuff just is like, yeah, okay. I mean, it's above the cloud, bearish ticket cross. How this is probably shaping out is an inverted head and shoulders into earnings, right? We're just sort of waiting for a catalyst as the tech favors bullish continuation. It favors higher highs. If we measure this, it measures to some ridiculous target. Maybe post CPI, this starts to take off, and then earnings, it gaps up to some crazy number. I don't know, right? It's just hard for me to want to play these binary events. It's just not really my game. Google also looks like a giant mess. Doesn't look bearish. It's fine, I guess. You know, it's got this old cup and handle target quite a ways away still. It's above the cloud. It's just been very, very choppy since the beginning of the year. Maybe a low time frame inverted Adam and Eve here. I don't even know. I don't even know what's going on there, but looks better than some of these charts, arguably. Certainly looks better than Tesla, which is still bearish, still very much a no trade. This zone here from 200 to 130 could form an inverted head and shoulders going into like July, September. Needs a lot of time. You can sort of see it, left shoulder, head, right shoulder yet to be formed, but it's hard to be default bullish on this until it's above the daily cloud. Meta, still in the daily cloud, just nothing super exciting. It's had a great run since 2023. I just think it needs time to relax. Same thing with Netflix. It's been quite rangy and choppy, but it's been up chop. So I don't think technicals are really going to help you too much here. It looks okay. It's on the bullish side of the cloud. But like I highlighted yesterday, I just think there's so many other better commodities charts than the Mag 7. WPM, COPEX, XLE, Morgan Stanley looks great. I mean, there's just, as a technical trader, not really a reason to want to trade much of the Mag 7. Amazon has reached its inverted head and shoulders target. At least it's been there for quite a while now. So as a technical setup, trend probably looks fine. But as far as the chart pattern is concerned, to me, this one's pretty much at its target. You know, it's got some room still, but the risk reward from here to 200 is a lot worse than it was at 138, right? As far as GME is concerned, I talked about this March 7th. This isn't like a back pat for me. I didn't take the trade or anything, but when we're talking about technicals, you do tend to see movements in things that are long left for dead for many years, right? This thing was basically down only for 3 years in this giant falling wedge. And wouldn't you know, we broke out of that today for reasons, right? Doesn't really matter. I don't really see a trade here imminently. I think this needs some time. But as far as trend is concerned, if this can hold above some high time frame cloud, maybe it has a chance. You know, I don't know. Really not for me. But it does look better than it's looked in the past 3 years, at least on the chart. The company certainly no better than it was Friday or over the past 3 years. It's just, this is all, you know, retail spec. Charts that do look good to me still, that haven't broken out. I mean, Hood, I guess, has broken out quite a bit. It's going to benefit from the meme stalkery coming back. Toast still looks great to me. Anytime I go out to eat, it's funny, I instantly see that. And they go, yeah, that chart looks good. KWEB, the Chinese internet ETF, looks great. on the weekly cloud. PayPal looks okay. So there's tons of options that aren't the Mag 7, that aren't semiconductors, that to me are just better trades here. I think remotely on hood, you have to be careful with head and shoulders here. But over the long term, I like these better than Mag 7 right now, right? And then lastly, Coin. Coin looks like it's acting more like ETH than BTC. So if Coin breaks up, it's likely because ETH has also broken up. ETH also has a falling wedge. You know, I don't think there's anything like pressing in the moment. The first thing we're going to see for sure, back to the BTC chart, is BTC breaking out potentially above 67. We'll see. Depends how bullish the market gets after that CPI number. So it's just a lot of wait and see this week. You can always pre-position before the number and become a hero, or just be forgotten when you lose everything after the number and it goes against you, you know? There's always somewhere in between where you're partially pre-positioned for the number and you wait and react on how the number looks, or you've got bids at, let's say, 59, hoping that there's some crazy volatility. Anyway, that's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.